All right, guys, we are back from the break. Do me a favor, just quickly raise your hand. Didn't actually do this before to make sure you are hearing me. There's a raising your hand feature in the chat. Okay. And obviously, I know you're hearing Mark because otherwise I'd be hearing uh, everybody chatting in there. By the way, just a quick throw out to Renee, who is here for her third time, absorbing new nuggets, as she says. And she's thanking me for twisting her arm to come back for a third time. So you're welcome. And some of you may be familiar with that feeling as well, because I know some of you I had to talk to and really force you over the top. But ultimately, you hopefully will be another one of understanding why I am so passionate about what we do here. With that said, we're going to get into fundamentals starting on page 63 in your workbook. This section should last about an hour, 20 minutes, 25 minutes, and then we'll have a 5-minute break before the last section. So let's get back to Mark and Mark.
Okay, guys, welcome back. We're going to continue with our day one here of Master Trader Program. And I want to first recap of what we just went through, what we just discussed. First of all, we talked about categories and catalyst, the various categories, the market leader, the top competitor, institutional favorite, turnaround situation. We talked about valuation, or the lack of valuation being a metric that we use. And again, we can look at the valuation and get an idea of whether the stock has a lot of expectation or not. But certainly using it for any type of pinpoint timing indicator, or even to know if it truly is undervalued or overvalued, is really hard to measure with like a PE ratio, simply because the market is a discounting mechanism. And I'm going to show you in just a little bit here how that translates into opportunity. And then also we spoke about the trend, non-negotiable criteria, and how we're not going to trade a stock. We're not going to get involved in a stock unless it already meets that qualifier, where we're in a stage 2 uptrend. At the very least, it's meeting the early turn criteria, where you've got at least a month of upturn in the 200-day or above the 200-day moving average, and so forth. So now we're going to get into fundamentals, which we call this section fundamentals to focus on. I talk about a lot of this in my book, in my first book, Trade Like a Stock Market Wizard. There's a section on fundamentals. In my second book, there is no fundamental discussion. So that would be the book to read. Some of you might have already prepped for this. I'm going to go over a lot that's in that book, but we're going to flush it out even more. And I think it's going to be very interesting. The thing about fundamentals too, and again, I swing trade, Mark Ritchie, swing trades. And if your time frame is really, really short, the fundamentals are going to mean less and less to you, because you're not maybe holding for several quarters and going through earnings reports and so forth. Certainly going through an earnings report is a fundamental that could affect you drastically if you're holding into an earnings report, that you get a bad report and it gaps down. And we'll talk about holding into earnings later on. But again, if you're going for the bigger moves and you're going to, you want to be in the best names, you want to have it all. You want to have the fundamentals, you want to have the price action, the trend. And when you put all these things together, you have a much higher probability of spotting a big winner. Now, I just want to point out, because some people, they'll notice that my trading, or I talk about swing trading and some of these shorter term trades, which we'll get into later on too. And then we talk about finding these big winners that make these multi-year moves or tens of thousands of %. The one thing that's very important, a distinction about how I trade, at least, whether I'm going into a stock, and this is really what specific entry point analysis is all about, for me at least. If I'm going into a stock for a short-term trade, even if I was going in for a one-day trade, I was going to scalp the trade, I'm going into it for, it's a market, maybe a potential market leader in a new bull market after a bear market, and I'm planning on trying to hold it for a big move, I'm buying at the exact same point. Regardless of the fundamentals, which we're going to talk about here, this is all underlying conditions that are going to build a case for the stock, if you will. I'm still buying at that same spot. And remember, we talked about reference points. The reason why I do that is because I know I'm a master at knowing what to expect under specific conditions. I've basically created this, this strategy that I have. So under certain conditions, I know what's normal, I know what's abnormal, and I've become an expert at that. So I stay in my own area of competence. So it's real important. And we're gonna talk about that later. All these things that I'm telling you are going to make sense as we move through the curriculum and as we get through the days. You're going to see how everything I'm telling you, there's a meaning behind it. There's a reason behind it, and you'll pull from it later on. Mark, you made a comment about that earlier, about how all this is important and it all is relevant.
Absolutely. Yeah. My experience early on, Mark, was, you talked about, being, more maybe a shorter term trader. And I was a little bit more focused on the technicals. And, a question we both get a lot is, so are you technical oriented or fundamental oriented? And we usually say both. We'd like to see both, but, when it comes to the really precise timing, which we're going to get to, we're certainly going to err more toward the technicals. But what I noticed in my trading, again, as I studied my own results, was that even on a shorter term time frame, often my best trades even were in situations that either had the type of fundamentals we're going to be talking about on the table. Well, that's because that's what institutions are, accumulating positions in. That's what's giving it that nice tailwind, and then ultimately the technicals we're looking for as well.
Yeah. I used to always ask David Ryan when he was my co-instructor. I'd always ask him each year, I'd say, Dave, in all the years that you were with Bill O'Neill, how many times did Bill O'Neill buy a stock that was losing money, or a company that didn't have fundamentals on the table? They didn't have good fundamentals. He said he never saw him do it once. So there's a great example of, if you're going to play for those.
David would say the same thing too. He would say that himself. How many examples did people ask him, David, what do you think of this stock? And he goes, there's no earnings. He would say that every time.
Yeah, even with the biotechs, you go back in again, one of the most famous biotechs, certainly that I purchased, David purchased, and Bill O'Neill purchased around the same time, was Amgen, and it had earnings on the table at the time, back in 1990, going into 91. Now, I do trade stocks that don't have earnings, and usually they're in biotechs. What we're going to show you here is I'm going to show you how this creates opportunity, regardless of, and it's going to put it all into perspective. It's going to put it into perspective the companies that don't have earnings, the companies that do have earnings, and the main thing, and what we want to understand is what attracts institutional money. What is going to bring the big money into a stock and support it in that uptrend? That's the real key. And like I said before, the real secret to this whole thing, or the advantage, I should say, that you have, is that you can know that information. Now, I'm going to give you all that information, right? The same information that I gave to the big institutions years ago, when I only advised institutions. And you'll have that information, but you'll be able to act on it much faster and be much more nimble. And you'll have the same tools and be able to apply tactics that are even much more effective because of your relative size. So let's get into this. And we're going to build some perspective here, and then we're going to get into some more specifics. But the thing I want to point out is that as I go through this section on fundamentals, I'm going to talk about a whole bunch of ways to look at them and slice and dice them from different angles. But we're only going to be talking about, and in my work, I really only look at, I look at a bunch of things, but I really weight 98% of everything I do is weighted in the fundamental area around three things: earnings, sales, and margins. That's it. No book value, return on equity. Some of these other metrics need to be compared industry to industry. Software companies can have bigger return on equity than a company in a different industry. So the three things, though, that are pretty much constant, and you can go all the way back to the 1800s, early 1900s, what drove Coca-Cola back in the early 1900s drove Monster beverage. Okay, nothing different. Sales earnings margins. That's what we're going to look at. We're going to slice and dice them different ways. There's only three ways that a company can increase earnings, and that is to either sell more of an existing product, raise their prices, sell new product, or cut cost. All right. So that's three ways: sell more, raise prices, or cut costs. Sell more of an existing product or sell a new product, raise the prices on your existing products, or cut costs, which could be you're getting rid of losing operations, you're streamlining productivity. That's another way. You're not cutting costs, but you're more productive. But here's the thing you have to remember: that cutting cost, ridding losing operations, streamlining your plant can only go so far. There's only so much you can cut costs, and then you've got to produce revenue. So revenue is really important. All right, you have to keep that in mind. Now, sometimes you'll see earnings. All right, you'll see big earnings come in, and you'll take a look and you'll see the profit margins are up, but the revenue's flat. The revenue is not doing very well. Well, that's because they're making more. They're making larger profit margins now, but they're not growing their revenue. So you could have flat revenue, grow your earnings by your profit margins expanding. But when you see that situation, that's a more tradable situation because you can't, you got to have revenue. You can only go so far on increasing profit margins, right? So the real power comes when you get it all. When you get revenue growth and you get profit margin expansion, these are the companies that are really doing great things. They're not only have some kind of product that's selling really well, but their management is really good, and they're improving their productivity. Their margins are widening. This is where you get explosive potential, and we're going to talk about that here. So we talked about the maturation cycle of the stages, right? Where you go through, and we want to be in stage 2. Remember, we only want to be in stage 2. Well, the fundamentals somewhat, not perfectly in line with the stages of the stock. There is a discounting mechanism of stocks, but basically you're going to have the cycle of the earnings maturation cycle is going to go through a 4-stage process too, where you're going to go from maybe a stock is a value stock, or it's out of favor, it's in that stage 1, it's nothing to write home about, and then suddenly it comes alive. And usually that's because some surprise happened, something changed, some improvement in the business. You have a lot of computers now where you'll have these computer models, and prior to computers, it was done by hand, but you'll have positive surprise models. They'll kick in, and then estimates get revised up, and then you get earnings momentum. As the company delivers these earnings, you get earnings momentum. And remember, I talked about that official growth stock. This is where, again, where you'll see it in earnings also, where you'll get to a point where the earnings are really solid and they're consistent and you can count on them. The dividend's been being raised for a number of years. And then you get a loss of earnings momentum, and the negative surprises come in, and then the negative surprise models kick in. And this is where the stock, if it hasn't already gone to stage 4, it enters into stage 4, and you go through, and it's right back to being a stock that's out of favor. And in stage 1, it could, and sometimes for years or even decades. So this is the maturation cycle. Just keep that in mind. And
Mark, I just want to add, go back to that slide real quick. We
Yep.
mentioned in the last section about how some of these stocks, that when we use the phrase, they're marching to the beat of their own drummer. This is because they're in this part of the cycle in terms of stage 2. So when we talk about a stock that's in its own maturation cycle, what we mean is, and I think we use the example of Apollo, or even during a bear market, this stock was having positive surprise and estimates revised up, and still had EPS momentum, was able to even buck, the pull of the overall market. And that's why this slide is really powerful, especially for those of you guys who want to play names for bigger moves. You have to understand this concept.
I think that's a great point, and that it keys off of, yes, some of the previous examples. And what Mark is saying is that you don't have to have the overall market in a stage 2 uptrend. All right. And in some cases, although you would like the market, ultimately, when you're getting a lot of stocks doing well and you're making a lot of money in the market, you're in a bull market, the market is doing well. However, a lot of leaders emerge in bear markets before the market even makes its low. And we've showed you some examples where you were in terrible markets and the stock still went up significantly for months and years. So not that we want to, get super aggressive in a bad market where there's not many stocks, and we're only seeing a few stocks and trying to pick that needle in the haystack, but it just shows the power of being in, as Mark said, in your own earnings cycle. When those earnings are coming in really strong, those are the names that, you know, have real staying power. That this is driven by earning surprises. And again, nowadays, you know, earning surprises are, you know, what is the real surprise? You know, you've got the whisper number. You know, it's not as easy as just looking for a stock that has better than expected earnings. But when you go back and you take a look and you look at the stocks that are performing consistently, especially against a weak environment, you're going to see that the earnings are, there are surprises in there. And that stocks move basically because of conditions improved and are better than expected in some way, shape, or form. Now, we don't look for earning surprises necessarily. There has to be a number of earning surprises, like a Zacks model or something, which is not a bad model. It's actually a very good concept of using earning surprises as selection criteria. But like I said, you will be driven by earnings as something doing better than expected. And what this creates, it creates what's called post-earnings drift. And it simply means that, and again, I'm going to get to a really important point in just a minute here. I think the next slide, actually. Post-earnings drift just simply means that not everything's discounted. Now, the efficient market hypothesis says that everything's in the price. So that would mean that if an earnings report comes out today, it's either already in the price or the price will move so quickly that it will discount it and you won't have a chance to really take advantage of that information. This is completely false. And in some cases, it's true. And overall, the market is very, very random. The efficient market theory is somewhat true overall. But there on individual companies, and certainly small and mid-cap companies that are not followed very widely, there's tons of inefficient pricing. And we see this all the time.
This is a really good point too. I was just going to add, Mark, I think, you know, the difference between perfectly efficient and mostly efficient has been worth many millions to both of us.
Yes.
And the idea being, yeah, we want inefficient pricing, and this is often, you know, where you're going to find it.
And we're looking for inefficient pricing. I was just going to say, Mark Ritchie is an expert in recognizing this, even without fundamentals, even looking at the charts. And we're going to go over that later, assessing alpha and going in those areas that are showing very efficient price moves with little volatility. This particular slide right here, though, and there's a little golden nugget there. We put a few golden nuggets here and there when we get to something that's really, really important. This makes a huge point here, and this is really the whole reason why there's this great opportunity in the market, and the reason why I've been able to do what I do for almost 40 years and consistently be successful, and Mark Ritchie and so forth, and Bill O'Neill and so many others. The way it works on Wall Street is that as companies do better than expected, you've got analysts that revise their estimates. They assess the company, and then they give these estimates of where they think earnings may be. Now, all these people, you'd think all these smart people on Wall Street and these tons of MBAs and PhDs and computers analyzing all these companies, you think they'd be able to be really accurate and peg this stuff, right? Even in the most widely followed companies like a Coca-Cola that have 100 analysts following them on the street. What happens is that for a couple reasons. One would be purely just skill. Two is to protect your job. And three is the nature of large numbers, which I'm going to show you in just a second here. What happens is that the estimates are actually revised very slowly, and they're revised conservatively because nobody wants to be the rogue that comes out and makes some outlandish prediction and be wrong, because their job is on the line with that type of analysis. So everybody sort of gathers around the mean, and nobody wants to make a real big move until it's obvious. And that's why you see a lot of these brokerage recommendations stuff. They'll be downgrading when the stock's, after it's down huge and near the bottom. They'll be upgrading at when the stock tops, and they're always behind the curve because they're moving very slowly and conservatively. Now, But here's the real secret here. And that is when and it goes back to earnings. And even if there aren't any earnings, it either the big earnings on the table or the potential for big earnings. For instance, a biotech doesn't have, sometimes they don't have any earnings or sales, but there's an enormous potential for maybe a blockbuster drug that can do billions of dollars at 80% profit margins. So that is what the stock is discounting. So what happens is when you get very large numbers, so for instance, Cisco Systems, all right. Cisco Systems had a huge run. It's one of the biggest winning stocks of all times. They had 16 quarters of triple-digit earnings. Now, when you have those type of earnings for that length of time, even looking out, let's just say, and I'm going to go back to the previous slide on page 68, even looking out just a few quarters or 1 year, the CEO himself cannot tell you that they're going to have triple digit earnings 4 quarters from now. Nobody could know that. So, and this is why when you get this super high PE, it doesn't really represent the true valuation when you have big earnings. If you have a company that's growing really slow, you got a grocery store and it's growing at 4% a year, yes, you can get a pretty good idea and the visibility is going to be a lot better. That's why there's no opportunity there. But when you get some software company or some companies on the cutting edge of a new technology, like when the internet stocks came out and nobody had a clue as to what that meant, but there was some intelligence in the market. It did, because those stocks all doubled, tripled, quadrupled. So what happens is, as these big earnings are coming in, there's an adjustment that's made. And because of this limited visibility, the stock could just keep going and going and going because it never fully adjusts. It never can fully adjust. You're looking at, I'm going to show you the example here. This will make a case. So just imagine you had a little company that you were a contractor, a plumber, all right, and maybe you're doing $500,000 a year in business. You make 6 figures. Your profit margins are 30-40%. Maybe you're making a couple $100,000. Okay, well, in the case of Cisco Systems, which is $100 million plus company to start with, I can't remember, they were a mid cap company back then. Let's just take $100, right, and we're going to double it each quarter for 8 quarters. They went 16 quarters, right? But let's just do 8 quarters and relate this to your own business. Maybe you're in, you're a dentist. You're, like I said, you're a plumber, right? Take your revenue, double it in 3 months, then double it again, then double it again, and keep doubling it. So in 4 quarters, in 1 year, your business would be 16 times larger. So if you're doing $1 million, in a year from now, you'd be doing 16 million. Okay, 4 more quarters, in 1 more year, you'd be doing 256 million. Now, apply that to a company that's doing 100 million, a billion, and you can see how an Amazon become an Amazon. And so these numbers cannot be discounted. Nobody knows, but if those earnings keep coming through, you're going to consistently get an upward adjustment. And that's where you'll get these opportunities, because along the way, the stock will correct, it'll pull back on news, it'll form a base, and you'll have these opportunities to get on board because, and this goes back to what I was saying before, where, okay, I may trade like Yahoo, I traded for 100% move, then I traded it for a 60, then a 30. I had a bunch of times I made hundreds of percent on Yahoo. It went up 8,000%. But on that big move, it afforded me all these opportunities to go in and out of it. Now, if I held it, that would have been just as good. Who knows? Maybe even better in some cases. Going back and looking, I bought Cisco Systems right off the IPO base, and I sold it for a 5-point move. So I didn't make much money on Cisco. It went up 70,000%. But during that same period, I made over 35,000%, which wasn't too bad. So trading.
And I'll just add, your drawdowns were far less than holding for that entire move in Cisco Systems. So
that's a very good point. During that time, Amazon, which I bought in 97 right off the IPO also, which went up huge, had I believe a 90% drawdown. So the other question is, would you really have even held? Would you really have held through all those pullbacks, or would you not sold, when you were up 100%, 500%, 1,000%, 10,000%? Are you really going to hold for an 80,000% move? But you can get to that big return because you're if you sell out on these trading opportunities, you're not making that big giant decision or having to come up with a way to capture a 20,000% move. We're going to get into more of that later, though. So again, we're still in. We're moving down to more of an aerial view now, okay? Because these are the fundamentals that we're going to put beneath the technical analysis. These are the things that we want to understand. One of the most important things, and my point here, it's not going to be like to go find a stock that has necessarily the strongest earnings. This is the real point right here. The real point is, no matter what I tell you about these fundamentals, as we go along, I'm going to show you ways to slice and dice them and what you want to look for, and what leads to super performance. But the important rule is that you never, ever trust the story. You never trust the numbers unless it's confirmed by price. Because again, if things are so great, the company's so great, the earnings are so great, the prospects of the future are so wonderful, why would the stock be in a stage 4 downtrend? Why would it not be? Why would it not be performing? Why would it have a relative strength of 13? There's a reason. Because stocks are a discounting mechanism. So you're always going to end up with, you want the earnings, you want the fundamentals, but here's the caveat to it: you never trade without the chart. Now, what's the other question? The corollary to that, or the opposite of that, is: do you trade without the earnings? Do you trade without the sales? Yes, you can. You can. You could trade on pure technicals. So this is another tool, another way to stack probabilities. And we've got to go back to the very beginning. Remember, I told you everything that I talk about is going to build on what I said previous. Well, we got to go back to the beginning when I said categories. Well, you have got to know the category. Okay, so what if we're in a biotech? We see a biotech setting up, and technically it looks great. They've got no earnings. They've got no sales. Well, if you were to eliminate all the biotechs based on earnings and sales, and you would require to have earnings and sales on the table, you'd eliminate about 75, 80% of all the biotechs and some of the greatest companies ever that discovered promising and exciting new drugs, because they're not trading on, most of them are not trading on earnings and revenue. They're trading on the FDA approval process and the prospects of a blockbuster drug, which again cannot be fully discounted there, because there's no certainty there. So that limited visibility, right? When I go back, and I'm going to bounce around, you don't have to jump around too. We're going to keep moving from the current slide that we're on.
I just want to highlight that last slide, Mark, to say, I think for a lot of folks that are new, this might be worth taping to your monitor or putting on the wall, because I've seen an awful lot of folks when I run into them and they go, well, I'm holding this stock and it's, per the last section, in a stage 3 or 4, and they should have gotten out of it a long time ago. This is usually why. They either fell in love with a story, or they got sucked into,
the numbers are still doing
well. The numbers still look great.
Looking good.
Yeah, the number still has triple-digit earnings. And this is another great example why you have to heed the technicals. And I remember David Ryan once saying, look, I buy on fundamentals and technicals, but I never sell on fundamentals. I sell on technicals, meaning I don't wait for the fundamentals to sour to get out of a position. And if, the last section on P, or the 2 sections ago on PE, should have been a good lesson why. And this is just one of those. It should be like a 10 commandments of trading. You can't fall in love with the story, and definitely don't listen to the company. Once the stock starts breaking down, absolutely don't listen to the company if they're telling you things are great. If the price is telling you otherwise, you got to heed the price.
Very good point, and that's what we're going to get to in here. In 1 second, I want to show you some examples why what Mark is saying is true. I fell in love with a couple stories in my day. It was luckily it was early when I didn't have a whole lot of money, but it cost me dearly. And I would call the company and talk to the the investor relations. I even talked to the CFO at times, and got this glowing dog and pony show, and that made me say, the stock's down, but I'm going to buy it because everything's good. The numbers are still coming in. So we're going to move forward. Well, real quick too, I just want to point out this opportunity is because of right here, limited visibility. That's the key. Limited visibility is your friend. That is your friend. Remember, if everything could be figured out, if we could nail down where the earnings are going to be for certain, and we knew all the information And we had some black box system. That's why this is in large part an art. We're going to give you all types of techniques and tools and a strategy to try to eliminate as much guesswork as possible. But if we could eliminate all the guesswork and you didn't have to do any real work and have skill involved, there would be no opportunity. There'd be no opportunity. You just put it in a spreadsheet, you hit a button, the computer would pick the stocks and trade them, and everything would become efficient. And the efficient market hypothesis people would be correct. See, but that's not the way it works, because there's 10,000 names. They can't all be followed by and followed perfectly and know everything that they have to know about the future. And the big thing here is when they got the big numbers, the law of large numbers, there's no one can know that a company is going to produce those numbers for years to come every quarter. So going back to never trust the story, never trust the numbers, and why someone like David Ryan said where he sells on technicals. Now fundamentals can go bad too, and that could be a reason to sell, but usually the stock price will pick it up ahead of time or coincident with it. And let me show you how that looks. So this is a term that I use called differential disclosure. I did not make up the term. It's actually used in forensic accounting, where when the forensic accountants look at, they'll take a look at the tax return, and they'll look at the quarterly, the reports that are sent to the SEC, and they'll read the annual report, and they'll look for discrepancies, and they'll look at the footnotes, and they'll look for discrepancies between those, because reporting to shareholders doesn't have any rules. There's no like SEC guidelines, but you have reporting to the SEC, you have very specific rules and guidelines. So what you say to the SEC and what you put in your footnotes could be a telltale sign, because sometimes they're very different between the things that they report to shareholders. So this is what forensic accountants will look for, and they call it differential disclosure. I use differential disclosure in a very basic, straightforward way. And the way that I use differential disclosure is I look at the price and I look at the fundamentals, and I ask myself, does it make sense? Does it make sense that this company just came out with 144% increase in earnings? It was better than the analyst expected, and the price drops 25% in a matter of hours, and it's the largest price drop it's had in the last 5 years on the largest volume, showing that institutions are piling out of it. Would that make sense? Is that earnings report really as good as it looks? Absolutely not. So you have to judge an earnings report not only by its face value of the numbers, but you have to judge it by the response to the numbers. Okay. So, and in this case, this is Crocs, and this was a clear-cut sell signal. As a matter of fact, David and Ryan talked about this many times. He was selling stock during this decline that he had held for a while. This is, again, we talked about this earlier. This is institutions piling out, but this came on the day where the earnings were up 144%. So again, looks like good earnings, but does it make sense? If their earnings report's so good, why is the stock getting clubbed? Okay, so this is how we apply differential disclosure. Now, let me show you how this works in real life. What happens is the stocks do a really good job usually at discounting negative events, negative earnings. When things turn and the earnings picture starts to dim, usually what will happen is the stock will go into the stage 3 and even stage 4. And remember, I talked about how in stage 3 you look for some of those big declines in heavy volume. That's sort of giving you a heads up that the crap's about to hit the fan technically, and then fundamentally, usually it comes down the road. So take a look at Crocs here. You can see that, and these are the earnings right here. These are the quarterly earnings at the bottom here. Now, you see some deceleration. They start to decelerate, but I don't really even pay attention to deceleration if it's triple digit or anywhere near. If it's 90%, if it goes from 144 to 90, I don't really pay attention to that. That's not going to really get my attention too much. So, but this stock decline on these big earnings definitely get my attention. And if I were in this stock, I was actually in this, but I sold way before this. I would definitely be selling. I would not be buying here. And you can see this is the stock that from that point went down 90%. But take a look at when the negative earnings come in. See, they come in at way after the damage has been done. Now then the minus 71, now it makes sense. All of a sudden it makes sense, right? So, okay. So again, let's look at another one. This is Vicor. And again, like I said before, almost all of these stocks that I'm showing you, I was in. Now, I didn't buy it at the low and sell it at the high, but I participated usually from the buy point that I'm showing you right to the day. This was a stock that I bought. It was coming out of the 1990 bear market in 91. Huge earnings. Look at these triple digit earnings. This is what fueled this big move. Now you see it goes into stage 3. You got a little bit of deceleration here on the earnings, goes into stage 4. Then you got flat earnings. Then look at the earnings here. Look at this difference. You can see that, and this goes back to what Mark was pointing out with the earnings maturation cycle overlaying over the stage 1, 2, 3, 4 technical cycle, where you see the picture here, the stage 2, look at the earnings. Now, stage 4, look at the earnings. The difference is, though, you're going to almost always see on the up moves, you're going to see the earnings will stay. You could go years and years and years and years, decades with having earnings and the price performing. But usually what happens is you get to stage 4 and then the bad news comes out later.
This is a good example, Mark. I mean, this last slide's a textbook one too, though. One thing you're always telling folks is that, look, the market is a discounting mechanism, meaning it's looking 3 to 6 months out. So when you see this rally starts, the market is discounting triple digit earnings for a few quarters. And once it tops, the market's telling you, the price is telling you that there's no more growth anymore. Crocs was a perfect example. And sure enough, then 2 quarters later, the negative to slow to no growth shows up. But if you wait for that to show up on the table, this is why you have to heed the price action, because the market is looking ahead and telling you that the growth is over for now, which is why Crocs had, and again, why you'll never see the two of us ever buy a break in a stock like that, because the smart money is piling out in anticipation of low to no growth in the future.
Right. And we're not giving right now, we're still in the perspective stage of an aerial view. We're not giving you saying these are particular sell signals, although we're going to get to sell signals. We're going to get to specific sell signals, exactly what you need to look for. And one of them, which is a late sell signal, is the largest decline on the largest volume, weekly and daily. So these would be sell signals, but you should be long gone. This would be like literally the last sell signal, or at least to stay away from the stock. So again, the point we're trying to make here, though, is for you to understand the discounting nature of stock prices and how to take advantage of it, and the nature of the way it works. Again, you have to have all this perspective, and then you're going to understand how to trade within this framework. All right, so real quick, just show you this a few examples. Of course, you can see here stock breaks on good earnings report, quote unquote good. 38 cents versus 37, beat expectations by a penny, 46%. Sales up, they actually beat estimates too. You see now after the stock's down, huge, comes off of, I don't know what, $80. It's down here all the way down on this earnings report down to $25. Now, all of a sudden, now the negative earnings. Now EPS down 24% on sales, negative 1%. See, and again, you can see the major break. You had the big major break, and that just led to a real problem in the stock. This can also happen on company issued guidance. You might get good earnings and they beat. For instance, this was happening with Netflix when it temporarily topped earnings of 57%, beats by 14 cents. That would sound like a great earnings report, but they lowered their guidance, and that's all that the street had to hear, and that topped the stock. Next quarter, same thing, lowered guidance. Green Mountain Coffee, some of you might remember this. Similar situation where you had great earnings right at the top, but as the stock topped, you kept getting good earnings. Even you had this snapback over here. You had a big quarter up 233%, and then after the stock is imploded from I don't even know what the price is up here, but it's a huge decline. Now 33%, huge deceleration, and now only 6%. See, the growth is gone, but the stock is already topped. So differential disclosure. Now, another thing I want to point out here, and that is that, as I said earlier, a good company doesn't necessarily make a good stock. There's tons of companies that were great companies that either went out of business or stayed down for so many years that you wouldn't have been worth being in the company because you would have lost so much time and your money would have sat there for a decade or two. So again, here, this is a perfect example. You know, if you remember Tilray, this is the Marijuana stock, right?
Yep.
Yeah.
Yes.
You know, the stock went up 1,000% in 5 weeks. Now, meanwhile, you know, you compare it to something like Macy's, which was founded in the mid 1800s, 130,000 employees, 25 billion in revenue. Tilray was founded in 2013. This was I think it's a year or two later. They had 330 employees, 28 million in revenue. This little company. I've made a fortune in stocks that are flash in the pan. Okay, so again, discounting. This is why price is so important, and not to get hung up on, well, I'm going to buy this quality stock and the earnings are good, the fundamentals are good. Well, even if it doesn't go down precipitously, even if it's not a stage 4 decline, it goes down 60, 70, 80% and stays down, it may not perform. It may not perform well. You want to be where the money is, where the money's going, and that's where price always overrides. Now, not only do big earnings fuel price, but acceleration. And now an acceleration can be from negative earnings becoming less negative to becoming positive, where positive earnings become more positive. And this is just a hypothetical example, but these would be quarterly earnings that are sequentially your year over year results, and they're accelerating sequentially. So you would compare the previous year to the current year to the previous year, and then sequentially moving forward. What I look for is to see if there's any in the last 4, 5, 6 quarters, if there's any acceleration in the earnings. And also I'll look forward 1 or 2 quarters, because 1 quarter, even 2 quarters, the street can get a pretty good idea of that. Even though it might not be totally accurate, the further out you go, the less accuracy you're going to have. You can get some accuracy out a quarter or two, and you can see not only if there's acceleration on the table, but if there's some acceleration that is expected to happen. So this is another thing. When you go back, remember I talked about the 95% club. When you go back and you look at the big winning stocks, 95+% of them had some form of acceleration in the previous 8, 10, 12 quarters. So you always want to look for acceleration. You also want to look at for earnings and sales accelerating. Again, if you get the earnings and the sales accelerating, we're going to look at profit margins too. That's where it becomes even more powerful. Okay. And again, in that stage 2 uptrend is where you're going to see this. And then the stock will top. And sometimes you just get blasted on earnings and it tops on bad earnings, and the earnings come in coincident with the top. Most of the time, the stock discounts it on the downside. Just bringing up a few here. Matter of fact, I'm going to bypass this. This is one that I bought right here, coming out of a nice big base here. The earnings, if you can see here, take a look at these earnings: 41%, 117, 48, 283. So you might say, well, that's not accelerating perfectly, right? Or even the sales.